Let's start a bit. Let's look at the possible catalyst for next year and the impact that you think market makers might have. Obviously, the stock exchange has already noted that that is going to be a key focus for next year.
Yeah, thank you very much, Wole. I think next year, as you noted, the Nigerian Stock Exchange is currently working and finalizing the guidelines to kickstart the operations of the market makers and equities market. And it's similar to what we currently have in the bond market. About a couple of years back, the Debt Management Office of Nigeria appointed some market makers, which FSDH is one of them, to provide liquidity for bonds and to ensure that there are a willing buyer at every point in time. That's similar to what the Nigerian Stock Exchange is currently doing. And what they want to use, to achieve is actually to ensure that there is willing buyer and willing seller of particular securities at a particular time, and that will provide liquidity for the market. That will equally restore confidence in the market. They are finalizing guidelines for short selling, such that if the market maker on a particular securities feels that the stock is going to go down, they can short sell and buy back later. So essentially, it's going to restore confidence in our own view. It's going to provide liquidity. It's going to be traded via two-way quote, bid and offer prices. So I think investors are actually
so overall a positive development, you think, for next year. Okay, let's talk about the Naira though. Obviously that has been a hot topic most of this year, and more recently because of the recent devaluation that we saw that the central bank announced. Give us your thoughts on the impact that is likely to have on the market going into next year. Obviously it makes things a little tougher for companies that have to import raw materials and other heavy machinery.
Yeah, that's correct. I think it's going to increase their cost of production, no doubt about that. But what we think will happen to the equities market is that this year, thus far, you recall that early in the year, the IMF announced that Nigeria was too overvalued and that there was a need for devaluation, but the central bank felt that there was a need for them to keep it stable within 3% on 150. And that sent a lot of signals to the foreign investors who feel that may eventually happen. Now, the gain they would get in investing in local equities here may not, the loss on the devaluation of the Naira when it really kicks in will erode that one. That was why they didn't, one of the reasons why they did not come, okay? But now that it has been announced, it's been implemented, we think there is going to be some little stability, so even though the future rate is about 164, 167, but I think it's going to give them some little confidence now to come into the market, and so which may likely have positive impact going forward.
Well, a lot of people will argue that the central bank still hasn't got a handle on this exchange rate, but let's move on. Very quick view on yields going forward, fixed income. Obviously, that's having a bearing on the equity market. They are extremely high right now. Where do you see them going forward?
Now, going into next year, we think the current yield are not sustainable. Now, and it's very simple. The yield curve currently is inverted. You see huge return in the short hand of the market, while the long term is slightly lower. But going into next year, we think that central bank will not be as aggressive in their monetary policy as they have been this year. They held about 7 meetings this year. 6 of those meetings, they increased rate. But next year, we think it's going to go down a little bit. They're going to revise the MPR downward by about 50 basis points.
In the next meeting in January, you think? Or
it may not happen
later in the quarter?
Yeah, but next year, we think after some time, they may likely reduce rate. And so yield may likely come down. If it comes down, it's going to send a positive signal to equities market.